Gold prices are stuck in a trading range ever since the Federal Reserve announced last week that it would not taper its asset purchases. Here to talk about what is the next catalyst is Ed D'Agostino. Ed, thanks so much for being with us.
Hey, Joe. Good to see you.
So, Ed, when you're looking around trying to find what the next catalyst is that's going to move gold out of this really tight trading range, what is it?
I think it's real estate. I've been spending a lot of time looking at this, Joe. And if you look back even a few weeks ago at what happened when interest rates ticked up, and they haven't even come close to reaching the mean historical rate for residential mortgage rates. Residential refis and new activity took a nosedive. Wall Street, Wells Fargo, Citibank, just those two combined announced 5,000 layoffs in their mortgage departments. I don't think people fully understand the impact that real estate activity has on the overall market. And then it has that ripple effect where if there's no home refi activity or new purchases, then you're going to see companies like all the electronics companies, Apple, Lowe's, Home Depot, it all trickles down and it hits consumer spending. And so I think that is a big reason why the Fed didn't taper is because they didn't want to back off on their mortgage-backed security purchases.
So then to keep an eye on the real estate that you're talking about, do we look at economic numbers? Do we look at certain companies? What are you taking an eye on?
I think it's a combination of employment numbers, the economy, and the Fed. I mean, I firmly believe that that's ultimately why the Fed didn't taper. I think that the refi and the mortgage market scared them.
So really, I mean, what you're saying here is that what a lot of gold investors should be looking at is real estate. Do you think this is one that a lot of people have overlooked? A lot of people who are at least in the precious metals market?
I think so. I think people, when they look at the precious metals market, look at interest rates. And the general consensus is that sooner or later, interest rates are going to come up. And they associate that as a negative with gold. I would argue that in this environment, it's the opposite. When interest rates go up, you're going to see a dramatic slowdown in an already slow economy. You're going to see the housing market take it on the chin. And that is going to be a big drag on the economy, and it's going to be very bullish for gold.
Sure.
The economy is still very fragile.
Well, final question is, what do you expect prediction in the price of gold? I mean, are we going to see a tick higher here soon, or is it actually just going to continue a downward trend?
I think we're going to continue to trade in a band. I think now is a great time to get positioned and start averaging in. I think by end of the year or early first quarter, I think that's when you'll start to see a more solid move back up.
All right, Ed. Well, as always, thanks so much.
Joe, thank you. Take care.
For TheStreet, I'm Joe Deaux.